What I have for you this week is a rather short case from the Dutch Supreme Court from July 21, and it deals with hybrid loans, hybrid entities, and leveraged takeovers. So let's have a quick look at the facts of the case. So we had a fund, the K fund, which I believe was a limited partnership in the UK, which had as target the X group, which I believe was a Dutch-led group. It in any case had Dutch taxable income, and it was in the clothing branch. It made, I believe, underwear, but it also made pajamas and stuff like that. And so what the K Fund LP did is it set up 4 different FCPRs, and we'll come in a moment and talk about what these are, to acquire the X group. And the FCPRs were divided basically between German investors and Japanese investors and French investors, and then there was one standalone big company which also wanted to acquire the X group. But I believe the standalone company's interest was 10% ultimately, and FCPR 1, 2, and 3 each held approximately 30%. And here we see what FCPRs are. They are Fonds Communs de Placement Risqué, I don't speak French, which are hybrid entities because they are seen as taxable entities from a Dutch tax perspective, but they are actually seen as transparent entities in France. So if you had German investors investing through these entities, they would have not ended up paying tax in France unless they were deemed to have a permanent establishment in France. And then it's also important in this case that there was a company called FSARL, and the reason FSARL is important is because in the initial plans, K Fund had to ask for the permission of the Commission, I assume, in connection with competition rules, to acquire the X group, and that was given. But FSARL at that point was appointed as the acquisition vehicle in France. So what happened in the end was FSARL acquired the acquisition rights, but then transferred them to our taxpayer, which we'll deal with in a moment. So the taxpayer was AUA, which is a Dutch co-op, and this was where we talk about the structure around 2010. I believe at this time there was still the belief that co-ops could pay out profits without any Dutch dividend withholding tax, which is maybe why it was set up in this structure. And AUA then had, it was a taxable entity, a subsidiary called BBV, and BBV had a subsidiary called CBV, and they formed a consolidated group or fiscal unity, as it is called in the Netherlands. And then the FCPRs financed AUA with 74 million euros in equity and 60 million euros in convertible debt. And the convertible debt the instruments were for 40 years. They carried a 13% interest, which was added annually to the principal, in other words, to the 60 million euros. And AUA had a conversion right. It could convert this into shares, one would assume. So this was how AUA was financed. Now it's important at this stage to mention that the investors put only equity into the FCPRs, right? So they were fully equity financed. And then there was a bank syndicate, and that lent 114 million euros to CBV. And what happened to the money that that AUA got from FCPRs was all of that was contributed to BBV as equity, and then BBV again contributed this to CBV, more or less in the same ratios as AUA had in debt and in equity. So CBV was financed with debt and equity from BBV. BBV itself was again 100% equity financed. And what happened then was CBV acquired the X group, and the idea was, by taking it up into the consolidated group in the Netherlands, into the fiscal unity, the profits that the X group made would be offset against the debt and the interest payments that AUA made on these convertible loans. So that, you know, on the day of acquisition, XBV might have paid, I don't know, let's say 50 million a year in tax in the Netherlands. But through the acquisition, even though XBV's business model hasn't changed, it was still doing the same that it did before, and it made the same profits that it did before, most of those profits would now be eroded, and it would basically pay 2 million in tax, and the rest would go up as interest to FCPR 1, 2, 3, and B, where it wouldn't be taxed because the FCPRs are tax transparent entities. And what the case does not discuss is whether this interest would be taxed in the hands of the investors. What the court do mention, though, was that the convertible debts were not recorded as such in the books of FCPR. It was simply the acquisition in X which was recorded as an asset. So it might be that also for the investors, the interest income was not visible, at least not for their tax authorities. But the case doesn't say anything about that. So,
a 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses.
Let's see what happened in the court. So there was a lower court which decided for the taxpayer that all of this was totally fine, and there was no issue with it. The Dutch tax authorities appealed the case, and then the appeal court found a number of things. First, it said that the interest on the convertibles was not deductible under fraus legis. And fraus legis is the Dutch doctrine for abuse of law. And what the court argued was, it said the equity of the FCPRs was partially converted to debt, and the acquisition of X was set up such that X's taxable profits would be eroded by the convertibles, as I just explained, thus effectively converting the equity of X into base eroding debt, right? And the conversion of the unequal equity in the K fund and the structuring of the acquisitions through the hybrid FCPRs and hybrid debt constitute a detour. In other words, you know, you could just have acquired X, but there was a number of extra steps made, and these steps had no business purpose other than saving tax, right? And the court also said that the tax inspector showed it to be likely that the primary purpose of the convertible was base erosion. This was shown also because the convertibles were not recorded as such in the books of the FCPRs, as I mentioned. And this not recording leads to a conclusion that the interest income on the convertibles were not taxable, because you can't see it, you can't tax it, and the taxpayer never argued against this, arguing that the interest was in fact taxable. And then the convertible loans had no impact on the equity of the FCPRs, right? I mean, to them it didn't matter whether they financed AUA with debt or with equity. They had their investor funds, and nothing really changed. They had their investor funds, they used the investor funds for acquiring X, and that is what they've done. You know, whether they've done it with or without the convertibles would not have mattered. Both facts would still be the same. And then the court went on to say the norm with which the convertible loans contravened, in other words, where you get the abuse of law, is the norm that the interest on loans without a business purpose other than to save tax should not be deductible, right? And then there has been no reasonable level of taxation limited on the interest deducted against the profits of X. And one of the rules that the Dutch fraus legis doctrine says is, you know, if Dutch tax is saved, but you can show that actually the deduction from which the tax is saved is taxed somewhere else at a reasonable rate, that might get you out of the fraus legis. But in this case, that was not the case. And the fraus legis doctrine also covers interest generated through acquisition from unrelated parties. Basically, the taxpayer argued that, you know what, this is a third-party acquisition it had. It was a transaction with a purpose, business purpose. The tax inspector denied that. He said, you know what, initially FSARL would have acquired the X group, but you, after FSARL acquired the rights to acquire the X group, you transferred that to CBV, and that is like transferring a subsidiary internally, right? The court and the Supreme Court didn't quite, especially the Supreme Court didn't quite agree with that argument, but it was very clear that fraus legis could also apply to acquisitions from unrelated parties, so you didn't need the doctrine of the internal transfer of a subsidiary. And then what the Supreme Court does is it basically agrees with the appeal court. And it says, first of all, the convertibles were financed out of the equity of the FCPRs. The interest of the convertibles were offset against the profits of X. That is quite clear, right? Since the FCPRs were tax transparent in France, the interest income was not taxed. The appeal court was right in determining that the motive requirement for fraus legis was satisfied, even if the acquisition of X by the FCPR had a business purpose, due to the tax-driven way in which the acquisition was done. You know, again, the FCPRs could just have acquired X directly. They could have acquired it through AUA and financed AUA with all the equity that they had themselves. I mean, there would have been much simpler ways of doing this. And then the Supreme Court goes on to say that allowing the interest deduction would be in contradiction of the aim and purpose of the Dutch law, which is to resist that the levying of corporate income tax can be frustrated continuously and randomly through legal actions which are unnecessary for the achievement of the otherwise business-driven goals, such as the acquisition of X. And I must say, I do agree with the court decision. You know, the idea that you started with the X group, which is a Dutch taxpayer, and it makes certain amounts of money and pays its tax on it, and then it gets acquired by Japanese and German and French investors, and all of a sudden it stops paying tax because some investment fund has a complicated tax structure which is settled. You know, at the end of the day, the investment fund doesn't live up to its promise of making X group more profitable for the investors. It simply took away the tax which the X group legitimately have been paying until that time. I mean, that's not pretending to drive a business and to make a business more profitable by saving tax is not really a very good business strategy, right? At the end of the day, you want a business, a fund, an investment fund making a business more profitable, to do so by making the business make more profit before tax, not make more profit after tax. So yeah, this is the decision from the Dutch Supreme Court. A short decision for this week, and I look forward to telling you about more cases next time. Bye for now.